Hi, my name is Sherilyn Yackel, and I'm here with William Lang, founder of Downriver Capital Management. Billy, can you give us a little background on Downriver?
Yeah, hi, Shara. I started Downriver in January of this year to create an institutional quality product for your average retail investor. I've worked on the institutional side of the business since 1996 and have always been really frustrated in terms of the quality of intellectual capital that people like my dad have access to. So we started Downriver to try to create an institutional quality product for people like my dad and other friends and family.
Hasn't that always been the case in finance? People with the most money have access to the best intellectual talent?
You know, actually, Shara, it hasn't. If you go back to the late 70s and early 80s, really at the advent of the mutual fund industry, some of the best talent in the industry was at a number of the mutual funds. You could take somebody like a Peter Lynch at Fidelity in the late 70s and throughout the 80s. He had a phenomenal track record, and he was at a mutual fund. So your average investor actually had access to Peter Lynch through Fidelity. However, in the last decade, with the evolution of the hedge fund industry, a lot of the best talent has left the mutual fund world and gone to the hedge fund community. And this brain drain, really, it's created just purely financially because the hedge fund managers can charge performance fees. You've had really the people that are the most talented moving to the place where they can make the most money. And the unfortunate thing is it essentially leaves the average investor with not the talent that they had back 10, 15 years ago. And that's what we're trying to alleviate in terms of starting Downriver, in terms of giving your average investor an institutional quality product.
So Billy, when you say you've worked on the institutional side of the industry, what does that really mean?
Well, the institutional side is really just the biggest pools of money. So the end client ultimately is like a foundation, endowment, some of the large state public and private pension plans. And for myself in particular, I actually worked on the institutional equity side. And then even within the institutional equity, I've always been on the small cap value side of the business.
So when you say small cap value, could you explain that?
Well, most people in the industry define small cap as anything that's $3 billion or less in market cap, and then micro cap is generally defined as 500 million in market cap or less. The value part of that just simply means that the companies are trading at a discount to the overall market, which the only times that companies will trade at a discount to the market is usually when they've stumbled or run into problems.
So why would an investor want to invest in a company that has problems?
That's a good question. But if you actually look at the trailing returns of how value stocks have performed relative to growth stocks, really in almost any period, value outperforms growth. Now there have been exceptions to that, and really the only meaningful exception was actually in 1999 when the tech stocks were absolutely going stratospheric. And all of those tech stocks, when they were trading obviously at such high multiples that they were defined as growth companies. So during that period, if you looked at a trailing 5 or 10 year return, growth actually for a very short period actually had performed value. You know, with that said, I think we all learned a lot from that period. And I think the probability of us returning to a greater fools type of investing environment is very, very improbable over the next few years.
So what are the pitfalls of this type of investing?
Well, the primary pitfall is certainly, bankruptcies, because whenever you're investing in companies that have stumbled and are having problems, the issue is that as an equity holder, that if the company goes bankrupt, the debt holders actually can get some value out of the assets in the bankruptcy court. But if you're an equity holder, essentially in most situations you get zero. So the key is to be able to be a value manager and avoid bankruptcies. And surprisingly, the old firm that I was at years ago, they were a very successful small cap value manager, but surprisingly, they did not protect against bankruptcy risk. So when I co-founded my previous firm, one of our big criteria was that we did small cap value, but we would not touch any companies that had leverage on their balance sheet. And through years of doing that, I have recognized that not only does it work and really enhance returns, it also saves clients and the amount of time that you're spending in terms of explaining a particular security that does go into bankruptcy, it just really is a better allocation of time as a manager and in terms of having your clients be able to sleep at night.
Are there any other differentiating factors with this product?
Yeah, another key differentiating factor is with our fund, our benchmark, or what we try to do each year for our clients, is to return 8 to 12%. This is in stark contrast to the way that most of the industry works. Most of the industry, if you're, say, a large cap manager, your benchmark is the S&P 500. So if the S&P 500 is up 10% and you as a manager are up 12, you're earning your keep. Conversely, if the market's down 20 and you're down 18, as well, in terms of particularly in the institutional world, you've actually done a great job for your clients. At Downriver, we don't view the world that way. In terms of, we think that the markets are going to be flat to potentially down over the next 3 to 5 years, and essentially, promising clients that we'll be flat to down for them over the next 3 to 5 years doesn't make sense. So instead, what we've done is we've designed a strategy where we feel like whether or not the markets go up or down, that we can still return 8 to 12% in terms of a full market cycle. So over the next 3 to 5 years, return 8 to 12% annualized each year.
So Downriver also offers a tactical ETF program. What exactly is an ETF?
Yeah, an ETF stands for an exchange-traded fund, which is a basket of securities that are supposed to replicate either a specific sector, say healthcare or consumer discretionaries, or an aggregate index in terms of, say, the S&P 500 or the Russell 2000. I think the easiest way to explain it really is through an example. So say, for instance, you felt that the pharmaceutical industry was going to do great over the next 10 years because as emerging economies do better, there's going to be more wealth in those areas for the people in those countries to be able to afford branded pharmaceutical drugs. That's not our view at Downriver, but as the example, if you had that type of a macro theme that you wanted to play, you wouldn't want to also have to decide whether or not you were going to buy Schering Plough versus Bristol Myers or Bristol Myers versus one of the other pharmaceutical companies. So with the advent of ETFs, now you can go and just buy the ETF, the U.S. pharmaceutical ETF, that is a basket of all the pharmaceutical companies in the United States.
What is the investment philosophy behind this product?
The idea of the tactical ETF product is essentially when the markets rally dramatically and valuations are very stretched, the idea of the tactical product is that at that point when, for instance, right now, the S&P 500 is trading at over 20 times earnings in the face of an extremely challenging outlook going forward. So in this type of an environment, we actually are hedging risk out for our clients. So on our equity side, we own the securities that in isolation we really like, but we don't want to take the broad risk of owning the market. So with the tactical ETF product, when the markets have run like they have, we're essentially shorting or creating a hedge so our clients are market neutral in periods like this. Now, conversely, if the markets were to fall dramatically and overstate in terms of where the market's overcorrected relative to fundamentals, then we would, on the way down, we would be selling our hedge positions. And then if it falls further where we feel like it's trading at a discount, then we'd be adding long ETFs, which increases the equity exposure or sector exposure. If there's a particular sector that had fallen dramatically out of favor, we may add that sector to the portfolio.
You mentioned you co-founded another investment management company in 2001. Why did you leave this previous firm?
I left the firm to start an institutional quality product for retail investors. The previous firm that I was at, they exclusively ran institutional money, and it really became, and they were a very successful institutional manager, but it was very frustrating to me in terms of people like my dad and other friends and family not having access to the product. So as I mentioned at the beginning, by starting Downriver Capital, essentially what we're trying to do is provide a product that would be equivalent of the mutual fund industry back in the late 70s, early 80s, where there really, there really is intellectual capital that are making good decisions for the clients.
Thanks, Billy. Appreciate your time.
Thank you.